Step 4. How to answer an exam standard question in 10 easy steps. Step 4. What we now want to look at is the narrative, the information that the examiner has given to us. We've already considered what we have to do, the requirements, and now we have to say, well, okay, there's a load of junk there that we have to read through. So, there we have it, highlighted in red. And the thing to remember about anything to do with the narrative is that the examiner does not write anything for fun. It's pretty obvious. If it's written down there, the examiner wants to take from that your answer. So, we take the first paragraph. Tricor Co. plans to buy a new machine to meet expected demand for a new product, Product T. This machine will cost $250,000 and last for 4 years, at the end of which time it will be sold for $5,000. Well, okay, if you know your investment appraisal, you can see now that there are 3 clear facts that we need in any analysis. Firstly, the initial investment, $250,000. Secondly, the project life of 4 years. And thirdly, the residual value of $5,000. Very simple. Make sure you highlight them. Make sure you pick these things up. Not difficult. Then we move on. Tricor Co. expects demand for product T to be as follows. So, we're given the demand in units across the page. The selling price for product T is expected to be $12 per unit, and the variable cost of production is expected to be $7.80 per unit. Incremental annual fixed production overhead is $25,000 per year will be incurred. Selling price and costs are all in current price terms. So, what are we told here? Well, importantly, from my perspective, we're told that the volume is changing, and we'll come back to that in a moment. We'll see that later. We're also given clear revenue and cost structures. Notice the distinction between selling price and variable costs that are given per unit. They will be affected by volume, and of course fixed costs, which are fixed. Therefore, they're given in total terms. Did you pick up on that last sentence? Selling price and costs are all in current price terms. What is that sort of telling us? Well, current price terms is all about inflation. And therefore, that means that we're going to expect some inflation here later in the question. Let's see. Selling price and costs are expected to increase as follows. Now, we have the selling price of product T, 3% per year, variable cost 4% per year, and fixed production overheads 6% per year. Now, first things first. There is more than one inflation rate. And given that there is more than one inflation rate, you should remember that we have to use a money or nominal analysis. We must inflate up. If there was a single inflation rate, it's possible that we could do a real analysis. Now let's look at the detail. Well, if you remember, just a moment ago, we talked about the revenue and cost structure. And I said to you that we've got revenues and costs that are changing due to volume. We also now have inflation. Now, the funny thing is this. Inflation is easy to deal with, you know, an uplift each year of, say, 3%, 3%, 3%, unless we have volume to contend with as well. If we have volume to contend with, we've got a number of things changing, and all my advice to you is this. With changing volume and inflation to deal with, always do a separate working. That appears to be what the examiner does, and your examiner tends to give you a solid mark allocation for it. Other information. Now, this is typical of your examiner in F9. What he tends to do is give you a whole host of junk at the bottom. And remember what I said earlier, individual paragraphs may relate to individual parts of the question. The other information at the bottom typically relates to almost all parts of the question, or can do. Tricor has a real cost of capital of 5.7%. Remember, that's before inflation. And pays tax at an annual rate of 30% 1 year in arrears. It can claim capital allowances on a 25% reducing balance basis. Okay, so we've obviously got tax to deal with here, and we've got the most classic example of dealing with tax relief. We are given the reducing balance method, which is very common. General inflation is expected to be 5% per year. Now that's an overall measure, and presumably we could use that with the real cost of capital to calculate the nominal or money rate of return. TRECOR has a target return on capital employed of 20%, and depreciation is charged on a straight line basis over the life of the asset. Well, that last sentence is a bit odd. Why are we given depreciation? Because we're calculating a net present value. Oh, if you remember, Part B required a return on capital employed. And the return on capital employed is a profit measure. So presumably, both the target return on capital employed and the depreciation information help us with Part B. So, from reading the narrative, I've understood that there are three workings that we will have to do. First of all, inflation for the operating cash flows. Secondly, tax relief and writing down allowances. And thirdly, applying the Fisher formula to get the nominal rate of return, the money rate of return, the rate of return including inflation. So finally, in summary for step 4, skim read the question for the big picture, then go through line by line, sentence by sentence, and remember, every sentence is written for a reason. It's not just there for fun.